This is the Bullhorn Daily for Thursday, 19th of June, your no jargon, no snooze breakdown of today's money moves and market madness. There was no trading on Wall Street today. It was the Juneteenth holiday, but plenty of action elsewhere. Today, we had a Bank of England cliffhanger, or more of a speed bump. Oil markets were freaking out, and Revolution Beauty's share price did a full face melt. We'll also look at why some central banks are cutting rates, others are sitting on their hands, and why it all matters for your wallet, even if you've never read the FT in your life. Let's get into it. So the Bank of England held interest rates steady at 4.25%, which means if you're on a variable mortgage, sorry, still no relief. But that wasn't a united front. 3 of the 9 voting members actually wanted a cut. Why? Because inflation, the rate prices go up, is coming down, but not fast enough. It's still at 3.4%, and the bank wants to see it closer to 2%. The problem is that the economy's already crawling. People aren't spending, job growth is stalling, and wages aren't popping off the way they used to. But rate cuts too soon could risk another inflation spike. Think of it like giving sugar to a kid right after bedtime. So, the Bank of England is doing the cautious parent thing, watching, waiting, and hoping it doesn't all go sideways. Meanwhile, central banks in Switzerland and Norway did cut rates, both by 0.25%. That's because inflation's already cooled in those countries, and they're trying to gently nudge growth back to life without making things worse. It's basically a global game of economic Jenga right now. London's stocks weren't thrilled about any of this. The FTSE 100 fell 0.58%, while the mid-cap FTSE 250 dropped over 1%. Why? Well, first, no rate cut means less hope, and second, there's geopolitical chaos. Oil prices are up quite a lot because tensions in the Middle East are getting very real. Israel and Iran have been exchanging missiles, and now reports say the US military is prepping for a potential strike on Iran. It's not confirmed, but markets are still spooked. And why do oil prices care? Simply, if a major conflict breaks out, oil supply routes could get messed up. Less oil means higher prices, means more inflation, means even more reason for central banks to hold off on rate cuts. It's a vicious cycle. Brent crude is now back above $78 per barrel. That's up 20% this month, and closing in on prices we haven't seen since January. Let's talk market movers, and by movers, we mean nosedives and rocket launches today. The biggest faceplant was Revolution Beauty, which was down 41% after Frasers Group, which is the company that owns Sports Direct and basically half of the British High Street, said we're out on a potential takeover. The runner-up was Hays, which was down nearly 10% after warning profits would miss expectations by a long shot. Hays is a recruiter, and it blamed a rough market for hiring permanent staff. So if you're job hunting, you're not imagining it. Also in the red was Page Group, another recruiter, down 8%. Breeden Group, which makes building materials, down 9.3% after some gloomy analyst notes. NCC Group and XPS Pensions both fell hard after releasing underwhelming results. Whitbread, the premier in People, meanwhile dipped after falling sales. But on the brighter side, BP and Shell rode the oil price surge. Both of them were up over 1%. Vodafone got a 1% lift after naming a new CFO, and Syncona, a life sciences investor, jumped nearly 5% after saying it'll wind down its portfolio and return cash to shareholders. Investors certainly love a clean exit. Let's talk consumer confidence. And according to the British Retail Consortium today, confidence in June is the best it's been since Christmas. It's still kinda bad, but less bad. And the most optimistic group, Gen Z. That's right, the same people who brought us Be Real and oat milk are now also feeling financially hopeful. Apparently, the recent bump in minimum wage helped, and there's slightly more optimism about jobs, spending, and personal finances. So if you've been feeling a bit more secure, you're not alone. In the Eurozone, construction is quietly having a moment. Output was up 1.7% in April, the best jump in over 2 years. Spain, Slovenia, and Portugal were leading the charge. But while buildings are going up, investor mood is going down. The Pan-European Stoxx 600 index fell for the 8th time in 9 sessions. Banking stocks in particular took a hit, with names like Barclays, HSBC, and BNP Paribas falling. Nobody likes war headlines and rate uncertainty. Markets across Asia were mostly lower too. Hong Kong's Hang Seng fell almost 2%, Japan's Nikkei dropped 1%, and China's main indices were solidly in the red. The big reason was again geopolitics. Oil up, uncertainty up, investor mood down. One analyst put it bluntly, the market's watching the chess clock tick toward midnight, which is ominous, but also kinda cinematic. Australia's unemployment rate stayed put at 4.1%. It's been steady for 5 months in a row now. The central bank there thinks it might rise a bit from here, but no major panic. And the US Fed left interest rates unchanged overnight, but hinted that 2 cuts are still likely this year. Mixed signals? Yeah, you bet. They also downgraded growth forecasts and raised their inflation outlook. Again, inflation is being that clingy ex that just won't let go. Looking at Friday, it's going to be all about geopolitics and consumers. UK retail sales and public borrowing numbers drop in the morning. Also, keep an eye out for Germany's producer price inflation report, US manufacturing data from the Philly Fed, and a little meeting between EU foreign ministers and Iran's top diplomat in Geneva, where everyone's hoping not to spark World War III. Fingers crossed. And that's it for today's Bullhorn Daily, your cheat sheet to the financial world without the waffle. Markets are shaky, oil is spiky, and central banks are as confused as the rest of us. But hey, at least Gen Z's feeling good. Don't forget to hit follow, subscribe, and tell your mates that finance isn't scary. It's just kind of complicated. We'll catch you tomorrow.